All right, I'm conscious of time, so I guess we'll kick things off. So I guess firstly, hello and welcome everyone to the Home Lending Health for Health webinar. My name is Jack Brown. I'm one of the partners at AP Group, and I'll be your MC today. Before we get started, AP Group acknowledges that our office is on country of the people of the Kulin Nations. We wish to honour the connection to country of all Aboriginal and Torres Strait Islander peoples and pay respect to their traditional custodians and elders past and present. At AP Group, we're fortunate to have an excellent finance team that specialises in the pharmacy space. I regularly benefit from Andy and Matt's knowledge when performing my own role, and I have no doubt that you will find this presentation valuable. Given this is only a quick 20-minute webinar, the plan is for Andy to cover off some of the key topics first, and then we'll open up to the audience questions at the end. If you think of any questions along the way, please use the Q&A function at the bottom of your Zoom screen, and we'll endeavour to get through as many as we can at the end of the presentation. So I guess without any further ado, I'll pass over to Andy, the Director of AP Finance, to kick things off.
Brilliant. Thank you, Jack. So today we're going to take you through three things. So the first of those is how banks will assess your borrowing capacity. The second that we'll take a look at is specific policies for pharmacists and healthcare professionals, and also have a look at lenders mortgage insurance and what that is and how you can avoid it. And then finally, we'll have a look at considerations for pharmacists and healthcare professionals to prepare their income for assessment with the banks. There's a couple of pitfalls, if you like, that we commonly see that we'll give you a heads up on when we get to that section. So we'll start off with having a look at how banks assess your borrowing capacity. And really what we talk about here is there's three key things. The first of those is the capital, so the assets that provide security for the loan, and what we're talking about here in a property purchasing context is the property itself. So the property itself, and then what you need to contribute as a borrower in order to meet the bank's policy requirements for the loan. The second is around capacity. So put simply, this is just your ability to meet the repayments of the loan that you're seeking to take out. And then finally, and importantly, is the character of the borrower. And here is what this is really about is you being able to evidence that you're a sound financial character. So you've got a history of managing your financial affairs. You've got a strong credit rating, and essentially that the bank can have confidence that based on your past behaviour, with your future behaviour, you will be able to meet the terms and conditions of the loan that you're seeking to take out. In terms of the specifics of how banks assess your ability to repay the loan, it's quite a simple equation. So what they'll do is take your income, all of your income, so your salary if you're employed or your business profits if you're a business owner, and then any other income. And so that might be rental income, for example. So they'll take all of that income and then minus off all of your expenses. So the cost of the loan that you're seeking to take out, the costs of living, so your grocery costs, electricity bills, etc., and then any other commitments that you might have. So that could be another property loan, for example, or it might be a credit card, personal loan. So it'll take all of your income, less all of those expenses, and is there a surplus or a deficit at the end? And a couple of key things to be aware of with this assessment is that the bank will assess you at stress test or affordability interest rates, which typically sit in that 9 to 10% range. The key thing here is just giving the bank and the borrower some cover in the event that interest rates do rise, so as they have over the last 24 months. So if you can meet your repayments at stress test rates, the chances are you'll be fine if circumstances change moving forward. And the second one, as a key thing to take away, is really just having a high level of borrowings can impact your ability to be able to take out a loan for the property that you're seeking. If you're presenting to a bank with multiple property loans, a car loan, personal loans, credit cards, etc., all of those things factor into the assessment and get assessed at stress test interest rates. And just to give you an example, a general example, so if you have a 20K credit card, which is not uncommon, and I'll just note here that each bank can be a little bit different, but if you've got a 20K credit card as a general statement, that's going to have about a $100,000 impact on the amount of money that you can borrow. So having other liabilities is significant.
Terrific. All right, thanks, Andy. I think it's fair to say that the primary challenge for most loan candidates is obtaining the required deposit. So I'm sure it'll come as no surprise to anyone that our finance team are regularly asked questions about this component. There's also some anomalies that relate to health professionals specifically. So this is what Andy will focus on in the next section.
Thank you, Jack. So I'll start this section by just explaining what lender's mortgage insurance is. So it's an insurance cost that the bank has to take out to insure them against the risk of the borrower defaulting on their loan. And they'll pass that cost on to the borrower. So generally speaking, that cost can range between $10,000 and $50,000 and beyond. So it's a really significant cost, and it's kind of viewed as dead money because the borrower doesn't really get anything for it. It's just an expense that goes into them being able to get the loan. So what we'll talk about here is the scenarios where lender's mortgage insurance applies, and also a couple of scenarios where pharmacists and healthcare professionals can avoid it. So if you take a look at the left-hand side of this slide, this is the most common borrowing scenario that's available to all borrowers, so pharmacists and healthcare professionals and ordinary borrowers alike. And that's where you can borrow 80% of the value of the property that you're purchasing. So you need to turn up then to the bank with a 20% deposit in either cash or property equity, and your borrowing costs as well. So that's sort of the most common scenario. For pharmacists and healthcare professionals, there's a number of lenders who play in the space of allowing up to a 90% loan without levying lender's mortgage insurance. And then finally, there's a couple of lenders that will extend as high as 95% of the loan, meaning that you've only got to turn up with a 5% deposit and cover your costs as well. So we'll take a look at the detail of those scenarios over the next couple of slides. So the first one here is the common scenario of an 80% loan. We've got the scenario of a $1 million property purchase plus your costs. The stamp duty costs that we've got on this slide are Victorian stamp duty costs, which tend to be a bit higher than the other states. But the key takeaway here is to buy $1 million property, you've got to turn up with around $259,000 of either cash or property equity to bring that to life. And then if you look at the repayments that are required to service that on the right-hand side of the slide, you're looking at about $4,900 for principal and interest repayments, and around $4,267 for interest-only repayments. One key thing we want to leave you with here is if you do go down the interest-only route, which many do, for a standard 30-year loan term, what it actually means is your repayments will be higher in the back end of the loan. So if you do a 5-year interest-only period, then you've only got 25 years to fully repay the loan. So that means your repayments will be higher over those 25 years than just paying standard principal interest for the whole 30-year term. So the next scenario, there's a number of lenders that play in this space that allows pharmacists and healthcare professionals to borrow up to 90% of the property that they're looking to take out. And the key thing, so it's the same scenario of $1 million property that we mentioned on the previous slide. And the key thing that we want to draw to your attention here is just that in this scenario, it's about $159,000 that you need to come to the table with in either cash or property equity to bring that to life. So it starts to get much more accessible for a pharmacist or a healthcare professional to bring this to life. Look at the repayments on the right-hand side of the slide. As you'd expect, they're going to be a little bit higher because you are borrowing 90% rather than 80%. So your loan is higher. Naturally, the repayments will be higher also. And then the other key thing that we'd flag here is that if you are borrowing 90%, depending on the bank, the interest rate can be higher at those higher LVR tiers. And so the third scenario here, where there's a couple of lenders that play in this space, is a 95% lend. And you can see there, $109,000 is the number that you need to turn up with. So it starts to get a lot more accessible than if you're borrowing at the standard scenario of having to come up with 20% of deposit. If you look at the repayments on the right-hand side of the slide here, $5,818. So they start to get a bit higher by nature of borrowing more. And the key thing with this policy is it's typically only available to owner-occupied purchases, so not for investment property purchases. And principal and interest repayments are the only repayments that are allowable. So if you're borrowing up to 95%, you're obviously quite highly geared. So the lenders want to see that you're going to start whittling away at that principal as from day one. And again, the same applies that when you're borrowing at these higher LVR tiers, it can result in a slightly higher interest rate as well.
All right, great. So just quickly for the audience as well, I can see the questions coming through on the Q&A feed. There's quite a few, so Matt from our finance team will do his best to compile them, and we'll answer as many as we can at the end of the section. And in the third and final section, Andy will talk about some strategies that you can employ to successfully evidence your ability to service a loan. This is particularly relevant for health professionals who often have complex employment arrangements, and or inconsistent or irregular income.
Great, thank you, Jack. So for any application that goes forward to a bank, the bank will have their policies around how they treat the income that gets put forward. So what we'll share with you here is a couple of examples of where we've seen pharmacists and healthcare professionals run into trouble, and they're things that you can watch out for and try to avoid if you are in the market to purchase a property. So the first of those is the common scenario where pharmacists hold multiple roles across multiple pharmacies, where they might be working in a PAYG capacity in one pharmacy, and then a self-employed capacity in another. In principle, there's no issue with that whatsoever, but the thing to be aware of is that often those roles can be more transient. And so in the event that you've got a PAYG role and then you change into a role at another pharmacy that's self-employed, you can't then use that PAYG income for your application for a home loan. The banks will only consider current PAYG roles. So it's just worth being aware of if you're in the market to buy a property and you're transitioning into different roles, just being aware of what impact that will have on your application. So that's the first one. The second is around self-employed income. Again, very common for pharmacists to do locum work and get paid through an ABN. Perfectly fine. Most banks will only consider that income when it appears on your tax return. So the key thing to be aware of here is a timing one. So if you're transitioning into that type of employment where you're getting paid through an ABN, and let's just say you transition into that employment in July 2024, then you've got to wait till the end of that FY25 financial year, and then to have your tax return completed in order for banks to consider that income. And some banks want 2 years of history as well. So again, no issue with that kind of employment and banks accepting that income for assessment, but it's a timing thing. If you're considering buying a property and considering transitioning your employment, just be aware of that, the impact that might have on your application. And we can always help you with that as well, to have a chat about what your plans are and how that might impact.
Okay, thanks, Andy. Look, I think you did an excellent job of simplifying what is a fairly complex process and making it digestible for us laymen's. But if you had to select a few key things to leave with the audience, what would they be?
Sure. So 3 things that I'd say to take away. The first is to reach out to a specialist healthcare industry broker. Reason being for that is if you'd asked me about the policies that we've run you through today 12 months ago, they would have looked a little bit different. And in 12 months' time, they'll look a little bit different again. So just having a broker on your team whose day-to-day job is to be across those policies for this industry, as opposed to a generalist who has to sit across multiple industries and can't feasibly be across all the things that are relevant to healthcare. The second is just around completing your capacity assessment. So if you are minded to purchase a property, this is the best first step. Even if it's not going to be possible for you tomorrow, it'll help you put some goals in place for what might be possible in 12 months' time or 24 months' time or whatever it might be. But just helps to start to get some stakes in the ground for you if that's your ambition. And then finally, if purchasing a property is a priority for you, just give yourself the best chance by being aware of how your income will be assessed by the lenders. And again, we can help you with that, give you some advice around what will be accepted and what will likely not. But yeah, giving some thought to your employment if you do have the intent to buy a property.
Okay, terrific. All right. So I guess that's the end of the formal presentation. We've got like 5 minutes or so, I guess, to go through some of the questions. there seem to be a few, and I guess I'm paraphrasing a little because I'm trying to combine a few questions here, but it seems people want to know, why is it that health professionals or pharmacists rather specifically, have access to a better deal? Maybe why do they require a smaller deposit?
Sure thing. So it's a good question. One of the key reasons is around the transferability of that employment. So a pharmacist who leaves their role as a pharmacist today and starts at another pharmacy tomorrow will likely be able to get a job quite easily at the same income. So banks can have confidence that if for whatever reason your employment doesn't work out, there's going to be multiple other options for you at a similar income level and allow you to meet the terms and conditions of the loan that you've taken out.
I guess another kind of common theme is around, I guess people looking for more details around the benefits of using a specialist pharmacy broker or someone with knowledge of the health space already, maybe as opposed to, a broker they've used previously.
Yeah, sure thing. So I think, one of the key things here is really around being across all of the policies and benefits that apply to pharmacists and healthcare professionals. So it's an ever-evolving space. And having someone in your corner whose job it is day to day to stay across what they are and how they move is advantageous. So you can't reasonably expect a generalist broker who sits across construction, hospitality, all those other industries to have all of the detail required in the healthcare space. It's simply not possible. So having someone whose day to day job it is make sure that you get the best possible outcome. And we have seen some nightmare scenarios where pharmacists have needlessly paid lenders mortgage insurance because the broker that they were working with wasn't aware of the policies that are available to them.
Okay. All right. So I reckon we could probably squeeze in one more. And I guess it relates to the previous slide, is people, asking the question, is one employment type better than another? If I'm thinking of buying a property, am I better off going to get a full-time, PAYG role, for example?
Yes, it's another great question. So no doubt a PAYG role is easy. So putting forward that employment structure to the bank, almost all lenders will accept it. And it's pretty clean cut and easy. But there's no, I wouldn't say there's any specific type that you have to go for. It's more just understanding how banks will assess the different employment types and making sure you tailor your employment accordingly. And I guess key things to probably be aware of is transitioning. So if you are minded to transition your employment from, say, PAYG to self-employed, it's just understanding the impact that will have. It's something we'd be happy to sit down with people with and run through some scenarios and how the banks might look at those. But yeah, one thing to be aware of is transitioning from one thing to another. But to answer the question succinctly, yeah, there's no particular structure that's best, just understanding how the banks will consider those structures.
Okay, cheers. So look, I guess that's our 20-minute deadline, and I suppose that concludes the webinar. A big thank you to Andy and our finance team for putting the presentation together, and thank you to all of you for attending. If you have any questions about the topics we covered today, you can reach out directly to Matt or Andy, and their contact details are on the screen now. We'll also be sending out an email containing the webinar, like a recording of the webinar, and we'd kindly ask actually if you could please complete a feedback survey so we can improve on these presentations moving forward. And we hope to see you at the next finance webinar, which will be on Tuesday, the 18th.
Thanks, folks.